Rob, good to see you. How's things?
Live, not live. What are we, Rich?
We are live. We are live. So, yes. And you are,
Hi,
are you?
Meredith.
Hi. So good to be back with you guys.
Yeah. So we should give a proper intro, which we often fail to do right out of the gate because, we have a great, we do. We just, but we have a great guest today, who's back on the show with us. And it is Meredith Whitney. So the name Meredith Whitney, if it sounds familiar to you, the 2007, 2008 mortgage meltdown crisis. Meredith famously, I believe, if I'm not mistaken, Halloween 2007, Meredith, which now this is crazy. It's like almost 20 years ago. It's hard to believe the time has flown that quick. But Meredith was a very respected analyst for Oppenheimer and put out a piece on, I believe, Citigroup that it really foretold some of the things that were coming down the pike. And yeah, she was widely hailed for it. I think you were like Bloomberg Financial Analyst of the Year, and they dubbed you the Oracle of Wall Street. Do you still get the Oracle stuff? I'm sure.
I think if people are looking for like a quick soundbite, it's written about enough so that people just pick it up. But I don't know. It was a long time ago. I still am. I'm still early, and I still do the same kind of thoughtful work. And this year's been a year where I've had a lot more right than I've had wrong. So I'm grateful for that. You take every year as it comes.
Right. When you're in the business of predicting things, right? It can be fortuitous. I gamble on sports nonstop. So, it's my lens on it. But this hasn't been a good year for you. A lot of the stuff that you've been talking about this year has rung true, and excited to get into all that. And thank you so much for coming back on the show, Meredith.
Yeah, great to be here.
Rob, your hand is up.
Rich,
Yes.
Rich, your treasured Cleveland baseball team, the Guardian,
Oh,
have
next topic.
flamed out. They're gone. Does that take some of the wind out of your sports betting sales?
No, no, not at all, really.
Okay, sorry.
No. But yeah, maybe
Full speed ahead.
some of the wind out of my sails in general, but not as it relates to that. So,
Do you think it
The
makes
winds
you
are out
more
of my sail
objective
with
when
Joe
looking?
Burrow out for the season.
oh, you're a Bengals fan.
Well, I'm a Joe Burrow fan.
You're a Joe Burrow. Well, we just traded Joe Flacco to the Bengals. I'm
I
sure that
saw
won't be
that.
that. Having watched him play a lot, I'm not sure what that's going to do for the Bengals, but Joe Burrow, yeah, hard not to like Joe Burrow, even as a Browns fan. He's having a hard time staying healthy is his thing, really. So we'll
Yeah.
see.
If you didn't like him before, the most recent quarterback, the Manning show, he's teaching himself how to play the piano. Like all those quarterbacks just come off so well, like as being very smart and disciplined, and he's so likable.
Yeah.
But it's been a really interesting. Been a really interesting college season and an NFL season so far.
What's your college allegiance, Meredith? You went to Ivy League somewhere, Brown, I want to say.
I went to Brown. So Brown didn't have much of a football team. I hate to be blasphemous. The Brown mascot, the Brown Bear, used to do mudslides to try to keep the crowd entertained. Let's see. It was really fun to watch Alabama last week. It all depends. Like I like Georgia, I like Alabama. My husband is a big Texas fan. They haven't been
Okay.
so much fun to watch this season. And yeah. Uh, it just college sports are so much fun to watch. So I love that. College Game Day is my single favorite show on television or anything ever because it's such a fun, happy thing to watch. But anyway, that's not what we're here to talk about.
I love it. Chat's getting fired up already. Crystal saying go Ducks, and a lot of people excited to have Meredith back on the show today. So let's go ahead and get into it. This is the big picture presented and sponsored by our great friends and partners at Depth. Nearly 2 decades of so ably supporting the mortgage industry, fintech organizations within the mortgage industry with their deep market fluency and their ability to story tell and to provide strategic communication, brand management, and public relations services for companies in our industry now. Do such a great job. Carrie Milam, their founder, her two excellent EVPs, Lindsay Neal and Leslie Colley. If you'd like to learn more about Depth, and if you need your story told, you can find them at depthpr.com or get a hold of Rob or I, or you can find Carrie, Leslie, and Lindsay on LinkedIn. So there's that. As always, join my esteemed colleague and co-host, Rob Chrisman. Rob, good to see you. You on the home front today?
Yes. I wanted to ask though, maybe one of the folks at Depth could chime in. You often talk about nearly 20 years of yada yada yada. When will it be 20 years?
September.
When
I
will
think it's
Depth have been
September.
around for?
Yeah, September of this year. It's September or October, I'm sorry,
Or
of
was
next year.
it, so they've been there 20 years.
It's no, I'm sorry, of next year. So it's yeah, they just had their 19th anniversary. It was like a month and a half ago. So coming up
Okay,
on 20 years, yeah, next year. So yep, yep, yep.
there we go.
On cue. I was yeah, October 2026. So there you go, Carrie. So and this week, very, very,
That's quite an accomplishment in any industry.
especially this industry though, which is very, very, as we're going to get into with Meredith, it's very cyclical and a little crazy at times, including this year. So,
Yeah, I think
so
it's also interesting to go back 20 years ago and think of, or almost 20 years ago, and their anniversary, which was when things matter. And certainly this week, the last 3 weeks, the market's been focused outside of mortgage on subprime and the lower end consumer and a couple of bankruptcies that have rippled through Wall Street. And subprime was really such a major factor in the mortgage space when Depth got started 20 years ago next year. And it was all about getting the timing right when it mattered. And it was within so many small independent players, it hadn't really caught hold of the big players yet because, Bank of America hadn't acquired Countrywide. There hadn't been so 2006 that was when the independent subprime mortgage players were starting to go tapioca, and what a time to start in the business. You think about that, there is not subprime in the mortgage space today. It's just not a factor. So you see subprime in the auto space, and not even in the student loan space. You see very high defaults and very high uh, 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 serious delinquencies, 90 plus day delinquencies in both student and auto for different reasons. But you just don't see it in the mortgage space. So the mortgage industry is just so uh, people haven't gone back to that time.
yep.
So Meredith, when people say, "Oh, well, look, there are cracks showing in auto lending, and there are cracks showing in credit card debt, or there are cracks showing in student loans," that means, there are going to be cracks pretty soon in mortgage. Do you agree with that, or do you disagree, and why?
I totally disagree with that because I don't think you see cracks in credit cards yet. You see cracks isolated to auto loans and student loans. Student loans is a different animal, right? So the vast majority of student loans are held by the government, and the government has told you know uh, people who owe student debt that they didn't have to pay for 5 years. And even though they were supposed to pay a year ago, they had a very, very generous on-ramp period. So people just haven't paid, and they're not paying. Serious delinquencies are over 11%, almost 12%. And that's dated. So that's as of June. I think by now, the Department of Education thinks that defaults and serious delinquencies are up to 25%. Only 36% of student loans are current. That is astounding.
Oh, is that
Um,
true? 36,
yeah,
only 36% of student loans are current.
are
Wow.
current.
I
So
gotta
that's
check that
Department of
out.
Education data. And with so if you look at auto debt has grown by well over 100% since the crisis. Um, student lending debt has grown by well over 150%. Credit card debt has only grown by 40%, and that's lower than inflation. So inflation has grown by 50% since the crisis. Credit card debt has grown by 40%. So you just have not seen. So when people think about a levered consumer, it's just not that. That's just a falsehood. So if you look at LTVs on homes, LTVs on homes are 24%, and that they at the peak they were 51%. And I think what's really amazing is so the mortgage industry's grown, somewhat since that time, but I spent a lot of time looking at the home equity space. The home equity industry at its peak was 711 billion in 2009, and that was against 9 trillion in equity in homes. Today, the home equity industry is the market is 411 billion, and that's against 36 trillion in equity. I mean, we're just in such a different scenario. So I think that people want to grab hold of the fact that there's going to be this big credit bomb. I don't see it. What I do see is the fact that the 60% of households are tapped out. They don't have access to credit because subprime credit card lenders are holding back and are actually trying to go up market and limit credit to subprime. And they don't have any other options because they can't access the equity in their homes because there's no such thing as subprime home equity right now. So the only thing that they can do is slow down in spending. So you see names like dollar stores really come off of peak valuations. We rolled over on the dollar stores. We've been positive on them from November to May, and the stocks have retraced 30%, basically 30% each. And then you see any names that would touch any type of lower end. They've hit a wall. It's not going to be a credit event. It's going to be a spending event.
Interesting.
Yeah, that is interesting. So do you think that, they in the home lending world, they talk about if you have a lack of first-time home buyers, starter homes, then that leads to problems up the food chain because the people who own a starter home can't find a buyer, so they can move up into a nicer home, and that owner can't move up, and that owner can't move up, and so forth. Does the same thing happen, do you think, with regard to uh, consumers in general, that they talk about the haves and the have-nots, and the haves are really supporting the economy and the have-nots aren't? Are you seeing something like that out there now?
Oh, there's no doubt about it. So last year, a lot of people talked about the K-shaped economy, and the data from the BLS, which really goes through income segments and what those income segments are contributing to consumer spending. That comes out. They postponed it. It'll come out on October 30th. So let's just go with last year's numbers. The top 40% of households are well over 60% of spending. The bottom 60% of households are well under 40% of spending. So the fact that 60% of US households have been against it, don't have any wiggle room, don't have any flexibility, it hasn't come through in the numbers because the top 40% of households have been spending, and the stock market's gone up. They have a lot of liquidity. Those are the people that have been accessing equity in their homes. There's an interesting, and so there's no interruption there. If you have, the party ends when the liquidity stops, and liquidity is stopped in the bottom half of, sorry, the bottom 60% of US households. The party is still going on for the top 40%. It's interesting in terms of the folks that have been accessing home equity. Equifax had a data recently that there's been a big increase in the use. So you guys know well, the number one use for home equity loans has been historically home renovations, remodeling. That has gone down while cash management has increased 57%, 56% of the last 2 years. So people are using the equity in their homes to manage their finances. Well, it's their equity to use, and it's cheaper than credit card debt, it's cheaper than personal loans, so that makes sense. But it just shows you probably more than 60% of households are struggling, but but you know, but there's only so much credit being offered in the system, and so only so many people have optionality. But to get back to your point, um, uh, I don't see I don't see that there's a problem in people having a problem selling their homes to upgrade. I just think that it's become from a seller's market, it's become more of a buyer's market. So people are walking away from deals on price, and prices are people are having to lower their price. But once they find a trading point, homes will trade. But there's still the inventory is better, but it's still not very good.
Mhm.
Yeah, inventory at certain price points.
Yeah.
You know, obviously during COVID, and the point I've made countless times with Rich is, do you really think a two-bedroom, two-bath condo in San Francisco or Manhattan is worth, $2.5 million? Probably not. But if anything, for example, in California or Texas goes on the market at, three or four, 500,000, it gets snatched up pretty quickly. So, especially at these rate levels,
Yeah.
rates aren't that bad. But
But
yeah,
prices are still high. So
it's been interesting to watch consumers, and I'm a big behavioral economist, or I should say a fan of behavioral economics. And my background, Meredith, I'm sure you knew, is in food science. And so when you talk about food, so don't were you snickering, Rich? Really?
No, no, it's
Was
just I
that
was
like a static?
thinking of you eating edibles. Actually, that's what made me laugh there.
Anyway,
Yeah.
so yeah, like a couple hours ago. So when you go to the supermarket and you watch consumer behavior in the supermarket, it's very quickly apparent, or it's quick to react, because instead of buying, Captain Crunch at $6 a box, you're going to buy the store brand at $3 a box or $4 a box. Or instead of, whatever it is, you're buying a store brand, you still need, shortening. Maybe you don't buy Crisco for $1.50, you buy the store brand for 99 cents or whatever it is. So consumers in the stores are very quick to react to economic conditions. And that's what I think is interesting. And I think that's what's occurring now is people will substitute goods, but you can't really substitute houses so much. Um, so yeah, but
well,
inventory has improved over, say, where it was 6 months or a year ago, but it's
I think
not great.
yeah, I think there's a generation that is assuming that they're going to be their lifetime renters because that's what they've that's what they've grown up with, and uh, that may be that may be fine, but from my perspective, the big thing in housing is there's no incentive for the biggest owner of U.S. real estate to sell, and so over 60% of homes are owned by households over 60, and they're not moving. And so that's the part of I think that's part of the equation where there's just not a lot of inventory. Something, and I spend a lot of time on home equity. The age cohort that has the most home equity debt are households over 60. They hold 41% of home equity debt, which is counterintuitive. I mean, that's up from 17% 25 years ago. So that's been, they're staying in their homes and tapping in their equity to manage their expenses. And because they can do that, there's no pressure to sell.
Yeah,
Meredith,
no baby boomer wants to admit that they are destined for an old folks home or assisted care. You
No,
know,
and also very few baby boomers can actually afford assisted care. So this is the Harvard Joint Studies on Housing data. Only 1 in 10 seniors can actually afford assisted living.
And
That's
they're
stunning.
all in the villages in outside of Orlando, I think.
Exactly. Yeah, yeah.
Don't get me started there.
Meredith, I'm assuming you're
Oh
not.
no. We need to get Meredith started on the villages. No, I'm just kidding.
I'm assuming you're not familiar with the Swerbinsky plan, Meredith, but it's making some real headway on the dark web right now. But for about a decade at this point, I mean, what are your thoughts on a seller waiving cap gains taxes or reducing them for owners of individual owners own 10 or less, not institutional, investment properties that sell to owner occupants? Does that seem, I mean, to me, that seems like it makes sense. I know Trump has teased a seller tax credit more broadly that would be insanely expensive and not realistic. And what I'm saying is waive or reduce cap gains institution or individual owners of investment properties that sell to owner occupants for, a 6 or 12 month window.
Or if it was I think, reflective of the fact that seniors' biggest asset is their homes, and so
Mhm.
many are asset rich and cash poor. I would narrow it to a very large, it's not really narrowing it to a group of seniors, and maybe
Ah,
that will loosen liquidity. However, it's the what can you afford when you sell your home? What's the
mhm.
alternative? So you waive this, you have more money, but are you really going to get anything a better alternative? And it just is with prices this high, it's hard to argue that. So the vast
Well,
majority of seniors want to age in place.
I think what I think Rich is talking about. So Rich, for example, has, 5 or 10 investment properties. Well, gee, if he were to sell one to an owner occupied, Rich is saying, hey, US government, forget the revenue that you would receive from capital gains tax. Forget, you're gonna take a hit on that. And then I'm gonna keep living in my house, but I'm gonna sell some of my non-owner occupied homes. And then Rich, who's the onus of deciding whether that house is going to be owned by owner occupants or not? Who's going to prove that?
Well, I mean, Fannie and Freddie should have, I mean, more oversight. Like, people that, list non-owner occupied homes as owner occupied. Again, in this day and age of data and information, I feel like there's ways to oversee that. I don't think that even though the recent news, Lisa Cook and all that, I don't think there's a widespread epidemic of people mischaracterizing the purpose of a home purchase. But yeah, I don't think you need to worry about that too much. I mean, I just think
But
if
that's not a huge the amount of people that own multiple homes as investors under 10, it's still a sliver of the market. It's not as big as this is why I got to the senior incentive. It's a much bigger chunk of
yeah.
real estate.
Do you feel more broadly, Meredith, that, and I generally am like let the markets work themselves out. I'm not a big government guy. Like, let market forces, do their work. But I do feel like where we're at with housing, where we've just ignored home building, not ignored, but we've been underbuilding to some level for a long period of time. Like in Ohio, where I live, like, it wasn't that long ago. You could buy like a $250,000 house. It was like kind of nice in a decent neighborhood. Now, forget about it. Like, there is just no affordable single family home inventory. And we've had these kind of things that have kind of built up over the years. Do you feel like federal intervention is needed on any level to help unlock housing and housing finance? And if so, are there any policies in the hopper or that appeal to you?
Um, I, so I don't know how much real estate is local, right? So I don't know how much federal policies can, and real estate taxes are local. So it's a local issue. And so I think that um, what conversations that I've been a part of, and I will be meeting with these same people later in the month. They want so to make housing affordable, first of all, manufactured housing is far more affordable than, stick by stick housing. But the critical function is the land. So you need some type of land concession from local governments. And I wrote about this. I've got to go back and do the math, but I published a book in 2003 about the fate of the states and the conditions with the states in the end, what would happen ultimately with state arbitrage, where people would leave high tax jurisdictions and go to lower tax jurisdictions, more affordable living, more flexibility. I wrote that, and what I always do with all of my research is I'll identify a problem and I'll offer solutions. And the solution is that states own a lot of assets. They've been asset gatherers. That's not really their function. So states have a lot of flexibility in terms of they can sell assets. They can sell municipal airports. They can sell toll roads, or they can create toll roads. But they also have a lot of property they can sell and unused government buildings that they can seed the land in those areas for affordable housing. The land component part is the big part of the equation that makes for affordable housing. And so that is what I think people in Congress are trying to work towards.
Yeah. In the Biden admin, they did some kind of, like incentive policy. I remember, like, for states that would rezone, and if I'm remember correctly, it didn't have much impact. It feels like these federal incentives to state and local municipalities to rezone, to change the land situation, to your point, it feels like they haven't worked really well, for whatever reason, and maybe they just weren't structured right. And that's why, like, and I get it, like it's tough federal policy, but like a federal, some sort of seller, and like when Obama was in office, he did a first-time home buyer tax credit that was really effective at the time. It was opposite end of the spectrum. It was, we needed more buyers in the market, and it worked, I think, by most measures. So that's why I wonder if some sort of federal seller incentive of some sort could make sense. It's
Well, you could.
But that's not, Rich, that's not going to prompt the states. You mean a federal incentive to individual homeowners,
to
or federal
sellers,
incentive to the
a federal
states?
tax incentives to sell your home.
Okay,
I
so
think,
Federal.
I think
I don't know how that would help
Yeah, for
local.
affordable housing, you could have federal incentives in terms of some type of arrangement with states and local governments where you get some type of federal credit for doing so. But it comes down to land, and then you have to be very surgical. Where is there housing demand? Where's there a mismatch between affordable housing? It's usually around factories and businesses that need employees that cannot find affordable housing. One suggestion is also having businesses subsidize housing for their employees and making some type of tax arrangement so that the businesses get tax credits for that. There are a lot of it's going to come down to taxes and land and an investment in terms of building the home. So,
Yeah.
that
I
makes.
would think. I'm sorry, Meredith, go ahead.
Oh, I would say that makes, so that's how surgically you get the housing where businesses need it. In this worked in terms of jobs training. I remember North Carolina was very successful on this very early on. Governor Perdue worked with, I believe it was Beverly Perdue, worked with community colleges and businesses. What skills do you need? Here's the training, and the businesses would either invest in those community colleges so they get the employees. Like it takes surgical community engagement with incentives.
And Rich, you do raise some good points, but lately it seems like some of the when you talk about federal tax credits or where the money is flowing out of the federal government, can you guarantee that it won't be politicized in terms of blue states versus red states? And oh, we're going to do this for this state and not not for another state. I would, I think that is suspect at this point. So, why should California do certain things and have money, say, flow to, Tennessee or
Yep.
wherever? Um, it's a difficult situation. If there was an if there was an easy solution, right, Meredith, things would be different.
Well, Rob, to
But
your point, businesses are fleeing California and moving to states like Tennessee. So all the more reason
true.
to get housing around employment opportunity.
This is The Big Picture, presented and sponsored by our good friends at Depth. Nearly 2 decades serving the mortgage and fintech industry with public relations, strategic communication, and brand management needs. Depthpr.com. Check them out. Pleased this week to be joined back again on the show by Meredith Whitney, enjoying a nice conversation about all that ails housing and the potential ways out of it. And yeah, and I get it, it is tough, but there are ways at the federal level. Again, it was done during the Obama administration with the first-time home buyer tax credit, and I'm suggesting maybe it's just homes that sell at or below area median value levels, or it's investment properties that are typically lower priced properties if they're just sold to an owner occupant. But I get it, it's tricky, it's tough, but it's I mean. And I think it could be applied to all states, and if it's a federal tax policy change, but we'll see. It's again, that's a massive amount of tax income to forego, and we have a huge national debt, something else to consider as you discuss wide-ranging tax policy. But um, so Meredith, we're kind of in a weird time right now. It's like, the stock market is at all-time highs. The bond market is at 14-month highs. Yet these stats that we cite, early stage delinquency, credit card balances and debt, um, other things, home equity being more tapped out than it's been in a long time. And, I guess, there's the haves and the have not theory, but there's just wild disagreement on where the economy stands right now. Obviously, there's an element that feels like the stock market's at all-time highs. Good things are in the future. There's certainly plenty of others that feel the opposite. The AI bubble has come out. A lot of the big stock market gains these last several months have been AI related. Any thoughts on that or the broader market dynamics that I mentioned?
Well, just to clarify, I don't think there's a problem in credit cards. The problem is isolated in subprime auto and student debt is a completely different animal just because of I think how badly student debt has been managed over the last 5 years. So hopefully that's on a path forward. And they're also talking about selling student debt back to the private portion of student debt back to the private markets. But of course, that could only be 36% of the 1.6 trillion that the government owns because that's the only thing that's current. So they'd only be able to sell something that's current. Everybody asks what is the real state of the consumer, and you're spot on about that. And I think it's because anecdotally you feel things should be one way, but you don't see it in the hard numbers, and you don't see it in the unemployment numbers yet. And I think it's a lot because unemployment is based on how many people are looking for work. There are 1 million people that have come out of the employment sector since April, I believe. So unemployment would be the unemployment rate would be much higher, but for the fact that so many people pulled out of the looking for jobs. On the spending side, look, you see it everywhere. So Delta reported today, and they said the high end is spending like crazy. The low end is just not spending. You have Pepsi reported today. They still said the low and middle. They went beyond that. They said the low and middle class is not spending. or they're being very, very judicious about what they're spending on. And then you go back and look at, 40% of households are powering over 60% of spending. And then there's been this enormous investment in AI. So the total investment in AI contributes 1.1% of GDP. So that's about a 3.6% total GDP. That's a lot. So there's a lot being masked over what we all feel to be real pain. So the pain being that actually the cost of owning a home is far more expensive than renting now. So the cost of homeowners insurance has gone up 70% in the last 5 years, and so much more in areas like California and Florida and in climate change zones. That makes it really really difficult to manage. And then just cumulative inflation, service inflation is going to go up. So you think about all of the tariffs that this administration has put on all the things that go into the replacement cost of owning a home. Homeowners insurance is only going to go up that much more over the next year. And auto insurance, the same thing, replacement costs. It's all of those rates are based on replacement costs. So things are going to get harder for every US household family who has optionality, who doesn't. And if you look at how FICO, the FICO score spectrum, the vast majority of near prime and subprime are with the bottom 60% of households. Prime and super prime, the vast majority is with the top 40% of households. And so you look at it, it's totally have and have nots, and that's only going to get more extreme because, again, the liquidity is flowing very very fluidly with the top 40% of US households, and there's no liquidity with the bottom 60%.
I'm gonna move to Paraguay.
Some stuff in the chat. Chris Owen saying 300% increase in HOI in Cali. Bill Dolly saying that they're having some success in the Houston area with local government zoning certain land areas for community land trusts where the buyer just pays.
I don't know if we'd want to use Houston as an example of great zoning trends. Anyway, I don't. Sorry, we just lost our Houston listeners.
The Houston, I apologize to all Houstonians.
Well, they know about it. That's Houston's had the most liberal zoning and then the highest flood rates.
Yeah. And yeah, we've got the other impediments you mentioned, homeowners insurance, the taxes. It has really been a challenged environment for, wannabe home buyers in this country that it doesn't appear like there's, anything on the immediate horizon. Meredith, it sounds like you, as we do, share concerns with like the lower end, right? The people that need homes that are not in the have category. Any thoughts on like ways out of this, like things systematically and structurally that we need to do with the housing finance system in America to, because I would kind of argue like our policies regarding builders has kind of put us into this mess. Like, for the last 20 years, it has made zero financial sense for a builder to build a home today under like $500,000, and 10 years ago it was like 300,000. It's just, that it was, the $100,000 you hear all the time from the National Association of Home Builders before a shovel gets in the ground. Maybe one example, but any thoughts on the way to fix the system more broadly?
Well, I go back to the conversation about ceding land, government land to these specific projects, and manufactured housing, which is always the cheaper. And I went to this was, I want to be right about this. About a year ago, I went on this is my glamorous life, on a manufactured housing tour with a congressional delegation. And these are really nice homes. I mean, they're not, they're great. It's great options. You wouldn't know just by walking in them that they were manufactured homes. But the cost is just so dramatically cheaper. So, uh, but again, the big issue is land.
It feels like, but
Yeah.
there's some sort. It feels like there's a stigmatism attached to manufactured
Well,
housing,
sure.
and
Yeah.
is
It's
that?
always been there.
But
When you talk
is
about
there a way?
manufactured housing, people will joke, "Oh, where's the trailer hitch?" "Oh, did you put the license plate in the kitchen cabinet?" There's all kinds of jokes, but yeah, to echo Meredith's sentiment, the technology there's the building technology in a factory is so much better than a stick belt on site. But for some reason, the investor acceptance has been slow to pick up. Fannie Mae and Freddie Mac, it's almost like pulling teeth, I've heard. The and where do you put it? To your point, Meredith, where's the land? Where's the quarter acre lot that's 20 minutes away from downtown, Knoxville, kind of thing.
Well, here's the issue with Fannie Freddie. So on the appraisal, it's hard because if you're building so there's no direct comp. So if you're building a manufactured housing community, there's no direct comp. So it's hard for Fannie Freddie to do the conforming mortgage because they don't have the data. So there's got to be some type of new paradigm underwriting uh, standard for them to be able to do that because it's right now it's just it's you're hitting a brick wall and you know that there's a solution. It just and you're like how can it be this complicated? It shouldn't be this complicated.
Yeah, you're opening up a new avenue of discussion that we don't have time for. But yeah, there's a lot of people out there who will tell you that Fannie Mae and Freddie Mac are going 10 miles an hour in the fast lane.
Yeah,
And Fannie Mae and Freddie Mac don't seem overly motivated to maintain or increase their market share of loans out there. And so where those products are going are to non-agency, non-QM or bond programs or portfolio programs at the expense of Fannie Mae and Freddie Mac. I have not seen a lot coming out of Fannie or Freddie in terms of, oh, we're going to start doing this with regard to collateral. There's been, Bill Pulte's made some moves on the credit side of underwriting, but not so much the collateral. So
Yeah,
and I would say Freddie seems more willing to accept, in this case, manufactured housing and the comps than Fannie Mae.
well, even in the actual region, there are no direct comps, right? If you have a new manufactured housing community, there's no direct comp anywhere near it. So that's the hard part of it. But I don't, Fannie Freddie have been in the penalty box for, you know, 16, 17 years. So they're just trying to not get in trouble. But
yeah.
that's not the solution that we need to advance affordable housing. So there's got to be some give and take.
Great point. Some public shareholders that would ramp up their pressure to produce better earnings and maybe play a little bit more offense. And we'll see what happens there. And Meredith, I'm going to get all kinds of emails and texts from angry people if I don't ask you about 2007, which I'm sure you are sick of talking about. But just take us back to that. I mean, that was a crazy year for you with that. Not only the Citigroup report that you put out, but even you foretold in interviews some of the looming problems with some of the big banks like Merrill Lynch and some of the others that kind of you know went to the wolves early. You were featured prominently in the book The Big Short, which is one of the more popular books. Why were you not in the movie though? You were not mentioned in the movie. That made note you were prominently featured in the book, but not the movie. Was there like some kind of problem with the producer or something?
I don't know. It was never, a lot of my friends were in it. It never, no one ever contacted me. So I don't know. There weren't a lot of women in that movie. But I think what I take away, and I never get tired of thinking of that time because it was so fast. I mean, I think about all the times I'm so lucky in terms of being in the right place at the right time. And I felt my whole career has been that way, that it's been so fascinating. What was so I never get tired of talking about it because it was such an incredibly complex, interesting time. But importantly, what was critical is what was going on in the housing industry leading up to 2007 and 2005, 2006 was such a big point because remember 2006, um, rates are going higher and Greenspan says everybody should take out an adjustable rate mortgage, which was nonsensical. And you knew that subprime lending was starting to blow up, and you saw a bunch of companies. And I had lived through this with subprime home equity and subprime auto all blowing up through the 90s. So I'd seen this before. So that's why it was familiar to me, and that's why I felt comfortable saying things that seemed so outrageous to other people because I had lived it, not to the same scale, but I had seen the fragility of markets when liquidity goes away and how companies can go out of business because the losses eat into their equity. So importantly, a lot of people have put on that subprime mortgage bet and got carried out. And while I could see this happening, I wasn't covering any of those stocks. I was covering the big banks, the credit card companies, all of the brokers, all the investment banks, American Express. So I saw this on the left side of me and I was paying a lot of attention, but um, the city call was specific to Citi, and I had been at at an investor event. The CFO, there was a new CFO at Citigroup coming from American Express, and I was close with him, and I had so much respect for him. And I remember the report that I wrote what with his move was who leaves a Cadillac for a Kia, right? Citi was not a well-respected
Mhm.
institution, even though a lot of people own the stock for the dividend. So at the event, someone said, I've given up modeling on Citi because it's just too complicated. And I thought, well, that's your job. That's what you have to do. And thought, okay, well, they restate earnings all the time. Let me just dumb this down in the simplest way. And that is always the best way to do everything. If you can't explain something simply, you don't know what you're talking about. So I just looked at this really, like, in retrospect, it sounds so obvious, but just the simple leverage at comparing Citi to every other bank in its industry size. And very clearly, they had to either, and this is why I say I'll identify a problem and always provide solutions. So I'm not just saying, I'm not, you just pointing my finger and saying this is a problem. So that they were vastly undercapitalized. They had to sell assets, raise capital, and surely they didn't have the earnings power to maintain their dividend. And the report was titled, "Is their dividend safe? Is the dividend safe?" Which, in retrospect, sounds so eerie.
Mm.
But at any rate, and I laid it out so that anybody could understand what I was talking about. A teacher, a vet, a landscaper, anybody would be able to understand this. And but that was about capital. And then it came down to the fact that the rating agencies had rated a lot of these mortgage-backed securities one time and hadn't looked at them. So there were trillions of mortgage-backed securities that needed to be downgraded, and I knew exactly where they stood on bank balance sheets. So as they started to downgrade, let me go back for a second. I worked with the FDIC, and they explained to me that the capital was the required regulatory capital was directly linked to the rating agency's rating on securities. So
Mhm.
that was a report called Ring of Fire, and that just, I mean, I could uh, uh, look at with pinpoint accuracy how much a bank would need to raise its capital based on what securities were downgraded. And so that worked on for a year going after. So housing and the mortgage market was sort of like the absolute background soundtrack to all of this. And you'll remember Bernanke and every other smart person was like, housing has never gone down on a national basis. There's no way it could. And my question was, why not? And so you'd look at Case-Shiller and you'd look at different ways that banks were modeling what their home price appreciation or depreciation was. No one was modeling depreciation, so that you could also see where their reserves were and where their capital stood on that basis. People just weren't looking at it this way. And to me, data leads me to everything, and I love it. So it doesn't feel like work. So I just was all in on this, and there was so much to work with. I feel very much the same way now, but to think about how, you know, I'll always think, how am I so alone on thinking this way? And then I'll beat the daylights out of my thesis and my numbers. And then when I finally get to the point of like, this is right, then I have conviction, but I don't go into it saying, of course I know this is going to be right. I work with the numbers, and then I check myself 1,000 times, and that's how I got to it. But it was clear as day. The collateral damage of people losing their homes and the emotional devastation was so even though I saw it coming, even though I predicted it, was still so upsetting to me. It was so upsetting to me to see people lose money when, my call was right on Citi. I remember Wachovia had a really bad way of accounting for their home price appreciation, depreciation, and they were an outlier. And I downgraded them to a sell. That was over the summer of 2008, and I could feel the management was like, when they lose an octave, they're like, that was upsetting to me. I remember my first year at Jackson Hole, the Fed Governors Symposium. I was invited in 2009, and I felt like how could I be invited? I don't deserve to be here. And I was sitting with
Jackson Hole invite. Oh wow,
Fed governors, and someone came up crying and saying, Meredith, thank you so much. You saved my life savings by your call on Wachovia. And I was like, and they were like, wow. And I thought, okay, maybe I deserve to be here for an hour or something. But the point is, like, you can do something with all of the numbers, and then still when it happens, it's still shocking and equally upsetting. So I give you the example, a year ago when I've been looking at for a change in home equity volumes for 5 years now as a site for a canary in the coal mine. Like, oh, people are tapping into their equity, there's got to be a problem. And after 16, 17 years, home equity volumes turned positive last summer. And then all of a sudden, like maybe a month later, you started to see private equity go after this asset class, and all these forward purchase agreements start to be announced with originators of home equity and personal loans. And then I see this Equifax data that there is this massive rise in the use of home equity for cash management, and the use of home equity for remodeling and home improvement has gone down 30%. The rise in accessing home equity for cash management has gone up 56%. I called it a year ago. It's still upsetting to me to see all that stuff, like where the numbers led me to see households struggling so much, if that makes any sense. So I'll go back to that time, because you can see different parts of that period and how they're different or the same to today's market. But it was such a massively important period in American history that I never get tired of it.
Very cool. Thank you for taking us down, memory lane, and it was outstanding. And this is where the point in the show I remind everybody: home prices have appreciated 50% in the last 5 years. At not historically normal whatsoever, but to some of Meredith's points about some of the things that led into 07, 08. But it was a great call. You were one of just a very, very small group of people that figured it out, and to your point, had the guts to go out there with at the time, which was a shocking to many people, prediction that ended up ringing true. But I want to thank you for making some time for us today.
Well, you guys are always so fun to talk to, and I always learn so much from you guys. So thank you.
Love it. And so much awesome stuff in the chat. A lot of really nice comments from all of our viewers. And I want to thank all of you as well for joining us. If you're listening to this on the pod or watching on YouTube, we do the show live every Thursday at 3 Eastern. Go to ChrismanCommentary.com to get signed up for that. Rob, want to thank you as always for being with us this week. And to our guest, Meredith Whitney, for making the time for the big picture today. Thank you, Meredith.
Thank you, guys.
All right. And
Thank you.
have a great rest of the week and weekend, everyone. We'll see you next Thursday at 3. And have a great rest of the week and weekend. Take care, everyone.